The masses would tell you that Nvidia is the top stock to buy right now. But is that really the case? We're going to dive in right now and find out. But stick around, because after Nvidia, I'm going to share with you 4 other stocks that highly touted investors see a lot of value in right now. Nvidia cannot stop making all-time new highs. It just keeps on climbing. Guys, look at this thing. Up 2,800% in the last 5 years. Up 234% in the last 1 year. Up 198% year to date. 200%, that's tripling your money in the last 11 months. It's really hard to ignore that. And the best part about Nvidia is it goes beyond just the stock price. Guys, look at these income statements. Look at this. You've got 5 billion, 5 billion, 7, 9.7, 11.7, 11, 17 billion, 27 billion, 27 billion, $61 billion. And the last 12 months, $96 billion. It just passed $3.5 trillion market cap. That would make it an expensive 35 to 1 on price to sales. But as you guys know, it looked pretty expensive probably back here as well. And it's really grown into that value in all likelihood. Why? Because as I say in so many videos, it's not just about ratios. And you might sit there and go, but Paul, you're a value investor. The right value investor. The value investing I'm trying to teach is looking at every company as a stream of cash flows. Every investment's a stream of cash flows. The faster those cash flows are growing, the more you must pay for the company. 2 companies exactly alike with the same revenue and profit today. If one's growing 20% a year for 10 years and one's growing 5%, you must pay more for this one. If you don't, you are missing out. These are the mistakes I made in the past. I looked at a company's current revenue and profit and said, this is what it's worth. That is absolutely wrong. Now, let's go look at the 8 pillars. Guys, everything's a check. Look at this 5-year PE of 219, 5-year price to free cash flow of 238. You know what I want you to do with these? I want you to ignore these. These are useless. Why? Because the company is making so much more money now than they used to. Their 5-year average free cash flow, $15 billion. Their last 12 months has been $47 billion, over 3 times more than the average of the last 5 years, which includes this past year. To sit there and say this company is worth 15 or 18 times free cash flow is a ridiculous statement that even I, a person who believes in not overpaying, would definitely pay a big premium for. But before we go further, what assumptions have to play out for Nvidia to be a buy today? And not only that, how likely is that to occur? Those are the questions that the proper investor asks. It's not just what's the potential, it's how likely is that potential? As an example, if I sat there and said, there was a 10-sided dice, and I said, you roll the dice. If you pick the number right, I'm going to give you $5 for every $1 you give. You would tell me, Paul, that's stupid. I would never do that. Why? Because if you're getting $5 for a 1 in 10 chance of winning, you're essentially getting 50 cents every single time you roll. So you pay $1 to win 50 cents, you're going to lose. But what if I said, every time you get the number right, I'm going to give you $50. Now you're like, wait a second. If I have a 1 in 10 chance of getting it right, if I win $50, that's 10% of 50. I'm getting $5 for every time I roll versus the $1 you're charging me. The exact same odds, different payout is a totally different investment. That's the same thing with stocks. Everything in the investments, everything you do in the world is about likelihood. That's why when you go give the money to your government for 90 days, they give you 4.2% because they're like, listen, you're going to get this money back. But here's an example. I had somebody in the last couple of years reach out to me and say, Paul, I got a great land deal. I'm going to buy this land. I'm going to do this. I'm going to sell it. I'm going to flip it. I'm going to give you a 10% return. And I immediately just started laughing. I said, 10% return. You're going to buy the land. You're going to control the land. You're not putting any money, all these lists of things. I'm like, guys, the guy knew what I did for a living. I'm like, you know how many apartments I have, right? He goes, yeah. I said, if I go put that money into my apartment buildings, I'll make 15%. Why in God's name would I give somebody I can't control into a deal that I can't control to make 10% when I can put it into my own asset making 15? That's the world of investing. It's about understanding what are your opportunity costs. And with Nvidia, there's a lot of potential here, a lot of great potential growth-wise, and a great balance sheet. Look at this debt level. This is nothing. This is absolutely nothing. And guess what? It's actually lower than this because this is based on their 5-year free cash flow. So the first thing I would say to you is, how much more growth does the company have? Let's see what analysts think about it. We go to analyst estimates. Guys, they have $1.27 in earnings per share right now, going to $5.83. That's almost 5x. That's like 4.5 times. So if a company's going to grow their earnings by 4.5 times in the next 4 years, 5 years, got to pay attention to that. Let's look at their revenue growth potential. 120%, 111%, 42%, 19%, 5%, 11%, growing from $60 billion last year to $250 billion in the next 5 years. 4x that as well. So what do we do? Well, guys, that's why we have to go to our stock analyzer tool. And the big key on this video isn't just about Nvidia. What I want to show you is, after we do the stock analyzer tool, some other value investors and what their top picks are for stocks from the Value Investors Club. And the reason for that is, I want to sit there and offer a perspective of saying the best investors out there don't jump on the most popular items. They jump on the most overlooked. Why? Because the popular one by the masses are the ones that go high, high, high and keep going for the masses. I was on a cruise recently for my honeymoon. 3 people on the cruise. I only met like 9 or 10 guys. 3 of them kept asking me every day, hey, what's Nvidia at? What's Nvidia at? Now, they didn't know I had this channel. I didn't want to take a dump on their investment. But if 3 people out of 8 or 9 are asking me every single day, what's Nvidia at? Does that seem euphoric? Yes. Does that mean it's not going to be a great buy? Not necessarily. Is it harder to be a great buy? Absolutely. That's the hard part. So when was the last time I did Nvidia in our stock analyzer tool? I did a 3-level analysis for 10 years. And guys, I did 10, 20, and 30% revenue growth in the next 10 years. That's a lot. Could it be greater? It could be. But at 20% revenue growth for the next 10 years, that would make their revenue 6 times greater in the next 10 years. It's currently $96 billion, because this goes based on the trailing 12 months. So we take it from $100 billion essentially to $600 billion in revenue, which is far greater. It would require a doubling again from year 5 to 10 based on analyst estimates. And if you saw, analyst estimates were actually decreasing in their growth rate. Could they be wrong? Absolutely. I did 30, 40, and 50% profit margin. I'm going to assume over time that it's not going to stay this high at 55%. Why? Because more people enter the markets. There'll be a lot more competition. Margins are likely to contract. PE. What PE do you sign on this company 10 years from now? The hard part is we take the bias of seeing the growth recently and the domination recently and apply it to the future. Nvidia is a great company. Been around for 30 some years. Great company. 20, 25, and 30. I thought that was high, but it could be right. I'm adding my 9% desired return in here. Again, no margin of safety, just the intrinsic value of 9 or 10% return to match the market. You need to add a margin of safety in here. I hit the analyze button. Guys, I have a low price of 36, high price of 385, a middle price of 125. Keep in mind, this price is skyrocketed. This middle number is skyrocketed over time. So it assumes that the growth rate continues to keep growing. This is a permanent plateau of Nvidia's revenue, which I'm going to assume going forward, and they're going to grow from here. But it still seems a little rich. If I want to add some margin of safety, let's say I put in 12.5%, I'm putting a higher return in, hit the analyze button. Guys, a low price of 28, high price of 285, middle price of 93. So what's the right price? I don't know. I'm probably going to add it to my watch list here at $80 a share, because I also believe that if it starts to fall because the market turns, there'll be a lot more downside. But keep in mind, guys, just a year ago, I wasn't valuing this company at $80 a share. It's very difficult for me to get around that, but they have absolutely outperformed. So that's what the masses think the best stocks out there are. But let's go to the value investors. There's a club out there started by Joel Greenblatt called the Value Investors Club. It's so exclusive. You have to give them a pitch of a company for them to let you into the club. And they also offer $5,000 prizes for the best pitch. Now, if you're not a member of the club, you can still see the postings, but the postings are 90 days old. It is an incredible area. Now, my personal opinion is people are a little too detailed in that area. I haven't looked at people's returns over long periods of time, and you guys know me. I like to stay very high level. And a lot of people do these small companies to check into. Remember, top investors look at companies in a combination of a Ben Graham and Philip Fisher method. What that means is give your margin of safety, but value growth. People always think that value investors don't value growth, and growth investing and value investing are different things. They are not. Everything here depends on your perspective. And here's how I view the top stocks to buy right now. I view them as one of the most overlooked and misunderstood opportunities out there. That's where you get value, is misunderstanding. That's also where you get hype, misunderstanding. That's the scary part. You can have misunderstanding. You have to have misunderstanding on both areas in order to have those extremes. Because when things are flying high like crazy, the misunderstanding is this will go on forever, this can't miss, and they don't look at a stock as buying a piece of a business. We went and looked at the top 15 stocks talked about in the Value Investors Club. Let me show you these top 15 right now. Here are the 15 most frequently posted ideas in the last 250 days, the number of posts. You guys recognize these: Lululemon, Intel, Skechers, Dollar General, Alibaba, Match Group, Tesla, Nike, Apple, Atcore, Crocs, Paycom. No idea what Daco New Energy Corp is. We all know Five Below. And Excelis Technologies, no idea what that is. So there's a lot of posted about things on things we understand. But the question is, are they misunderstood from an investment perspective? The ones I was most shocked to see, Tesla and Apple. I thought to myself, wow, they're posting about this? That's interesting. And of course, guys, I love Alibaba. I own Alibaba. I own Intel. I own Paycom. So for me, seeing these are kind of like, oh, this is kind of nice to see. Other people are seeing value here. But remember, I don't go in here and just buy what they have. And you shouldn't buy what I have or anybody else on the internet. The key that we're trying to do is teach a process of thinking. And if you apply that process of thinking in a way that makes sense to you to investing, you're likely to do better than copying anybody else in the world. So, one stock is Tesla. Here are the ideas behind Tesla. Tesla stock will be the most valuable company in the world if it solves autonomous driving. And if it doesn't, this person says it's probably worth 90% less. So, let's recap that from just the start. For me, that's an automatic I'm out. Because to have such a high market cap that relies on such a small piece of the business being the reason why the company can justify it going higher, that makes me scared. I look at going, it's not for me. It's not for me at all. Could it be for you? Absolutely. Could it be a small amount of money? Sure. But I look at Tesla and I think it's a car company. I look at the revenues. Does it have potential for everything else? For the autonomous driving? Absolutely. I've always said that. It has this potential. But to value it at almost $1 trillion off of something that hasn't even occurred, hasn't even generated the revenue yet, that's a scary thing for me. They continue on. In 2020, the full self-driving was crap. And everything changed beginning in 2022 and was noticed a few months ago when they shifted from a code-based system to a neutral net design, which removes human imperfection on performance. Now, what they're sitting there saying is, that was a big issue with self-driving. How do they make decisions on what decisions are made while driving versus a human's decision? Now, I have a Tesla Cybertruck. I've got my updated self-driving. I haven't used it yet. But these are the important questions you have to ask to sit there and see, will this be taken? Now, remember, Tesla is a phenomenal company. They've doubled their revenue, over doubled their profits since hitting a high of 414 as a stock price. But it fell 75% to 100. Now it's back up to the 200s. Their thesis continues on. People will choose a second best smartphone. Think like Android versus iPhone, the battle there. But every year, 40,000 Americans die. 2 million people die every year from car crashes worldwide. If there's a best-in-class full self-driving, people are likely to pick it every time and not number two. It becomes a winner-take-all business, which I think is a great point to make. But again, to my point, if they're right, if FSD doesn't work, is this company worth as much as it's worth today? Probably not. And if it does work, is it worth 10 times what it's worth today? Probably not. So I look at that saying, where's the juice versus a squeeze? That's the hardest part for me. Company number 2, Match Group. This is the largest player in an ever-growing online dating industry, trading for single-digit free cash flow multiple. Down from its high in 2021 of $160. It's $37 today. And since that time, revenues have grown 16%, cash flows are up 93%, and earnings are up 134% since 2021. And shares outstanding have been purchased back down almost 10% in the same time that stock has fallen. And fundamentals have improved. Here's what they got. 57% of revenue is Tinder. 15% of revenue is Hinge. 8% of revenue is Asia. 20% of revenue is evergreen and emerging apps. In terms of total growth, 70% of singles in the US are not on an online dating app. So there's immense runway for this growth. Guys, think about that. I meet people now, and when I ask them, where'd you meet? If I hear anything but online, I'm like, really? Why? And yet 70% of singles in the US are not online dating right now. Now, I don't know what their data is. Is it 8-year-olds who aren't online? Whatever it is, there's a huge potential there. Also, the bulk of their debt is due between 2076 and 2031. So they don't have much in terms of near-term maturities. That's always a concern for a lot of places. Why? You have to make sure that they can refinance those maturities as they come due. Because there's a cash crunch and they have to refinance, that's going to be a problem. Look at this chart for Match Group. $182 was the high, 52-week low was $27.66, and it's currently at $37.80. Analysts, over double EPS in the next 4 years, according to analysts. Big time growth there. And revenue, 5, 6, 7% a year. And guys, that's all you need for a great business. You don't need to sit there and grow 20% a year to make a good return. What you need to do is find a great company that's overlooked and selling at a price that's very good. So let's go see, what is the stock analyzer tool for us? Let's see if I even agree with this thing. I did Match Group back in August 29th of 2022. Now, guys, when I went and pulled up the Match Group I did in the past, I was super conservative. I had not yet bought into the whole idea of Philip Fisher's go buy better, go buy growth and pay a premium for it. I was way too conservative, and I was responding to a recent report they'd had. So I went and redid it. 10 years analysis, 3, 6, and 9% revenue growth. Profit margin, I did 10, 14, and 18, and free cash flow is always significantly higher here. Look at that. So I did 22, 25, and 28. I did a PE of 15, 18, and 21, and a 9% desired return. Again, no margin of safety. Hit the analyze button. Guys, 20 to 44, 70 to 110, 40 to 70. I don't blame people for looking at this thing at all. I look at this saying, if you believe this price, this looks like a screaming deal. You're looking at 50% margin of safety here. And that's what's incredible. Now, one thing I don't like, even though their debts aren't mature for a while, it's still a lot of debt for their free cash flow. 770 million free cash flow average. They have about 3.5, 3.6 billion in debt. Now, their balance sheet overall could still be fine because this doesn't factor in their cash on hand. They've got 1.3 billion in cash on hand as well. That definitely helps out a lot. Cash and cash equivalents. That definitely helps out a ton. So for me, I'm going to look at this and probably sell some puts at a lower price. But again, don't do it just because I do. You have to do your own research. And I'm not going to buy this at today's price. I'm going to put puts at a much lower price and go do more research. Because you got to remember, online stuff, online dating, even though Match Group is awesome, it's going to be competitive. Now, over time, a clear leader will come up to the top, and it's probably going to be Match Group. But you got to factor in, is it possible it's not? Is 18% potential return enough for that? Maybe it is. I would say it is. Stock number 3, Dollar General. Now, Dollar General obviously goes after a lower income consumer, and there's been a lot of decreases in SNAP refunds and taxes that directly hurt Dollar General customers, while the rest of the economy, on paper, seems to be doing quite well. In 2016, 6% of Dollar General sales came from customers using SNAP benefits. And if that remained constant, which seems unlikely given the stimulus handed out over COVID, the 20% decrease in SNAP in 2023 would result in a 1.5% decline in revenue alone. And also, labor shortages have kept this SG&A cost higher for Dollar General since 2017 than its usual historical average. Another thing, rural customers make up 70% of Dollar General customer base. and they're hurt the worst during economically tougher times than the urban consumer, who are typically trading down from higher cost stores to take advantage of Dollar General cheaper goods. Now, here's an impressive number. The company is currently targeting 12,000 more stores to reach its total capacity, with 80% built in rural communities. And new store economics are still strong, with management citing a 2-year cash payback period. 2-year cash payback and 18 to 20% returns thereafter. So this company, Dollar General, has absolutely gone through the ringer. Let's look at this chart. All-time high of 262 back in April of 2022. It's currently at 80. Hit a 52-week low of 78. So it's pretty much right there at the low mark for the year. A big drop, almost a 70% drop. Now, come and look at a couple things I don't like. 5-year free cash flow, 1.5 billion. 5-year net income, 2.15. Significantly different. Now, last year's free cash flow was 1.7 billion versus 1.42 in net income. So it's maybe it's flipped here. Okay, same store sales growth, we have to go look up. Let me go look up the same store sales growth on their 10K that I get from our website directly. Comparable sales stores. Now, same store sales growth has occurred every single year since 1990 for Dollar General. In 2023, same store sales only 0.2%. So they almost lost that record of 33 years in a row last year, but they got it. Let's go see what our stock analyzer tool says about Dollar General, going back to the last time I did it. I did 3, 5, and 7% revenue growth. One thing to point out, ROIC declining. For those of you who don't know what ROIC is, it's the return on the money that's invested in the business. You want a high return on invested capital. That means they take the cash in the business and they're able to invest it and make more and more money at a higher rate. Higher rates of capital, returns on capital, you need to pay a premium for. It shows there's a moat, and it shows they're very good at handling their money. The fact that it's declining, even when they're trying to open more and more stores, doesn't really match up with that 2-year cash payback period and the 20% returns when they open a store. But either way, let's continue on. I did 5.5, 6.25, and 7% profit margin. I did free cash flow 4.25, 4.75, and 5.25. Now I did a PE of 13, 15, and 17. I might actually go lower, but either way, I did a 9% return. Let's hit the analyze button. I really want a big margin of safety here. Wow. Okay. Low price of 100 to 140, high price of 210 to 280, middle price of 150 to 200. So actually, 19% return based on the current price. That might be enough margin of safety. That could very well be enough. That's the beauty of using this. That's the beauty of using our stock analyzer tool. Keep in mind, guys, I will repeat this till I'm blue in the face. Remember, the principles that I talk about, they have to be repeated over and over. I want you to realize that when I sit in my office looking at investments, I repeat the same basic principles over and over. Every investment's the present value of all future cash flow. Is this company going to be around in 10 years? Is their revenue profit going to be higher? Can I pay a reasonable price today, factoring in that future and getting an adequate return on my capital? I repeat these till I'm blue in the face. Why? Because the second I stop doing that, it's like you're going to miss that. Just like swinging a golf club. If you give golf for 2 years, it's going to be very difficult. Just today, I gave up golf 6 years ago. I play once or twice a year. Today, and my brother always says I have the best swing that he thinks that he's seen. And today I swung the golf club in our simulator and it was absolute junk. I shanked 2 shots. Now, would the swing still look good? Yes, but I have to tweak some things. Same thing here for investing. You got to repeat these things. Every investment's the present value of all future cash flow. And the great part is we got our own little value investors club here in our community. These are the people in our community talking about their ideas. And we're going to get more of those people into this community. Use the tools here to sit there and calculate your returns based on the ideas you're making. Now, I didn't sit here and say anything, I'm going to go buy this. I said I'm going to sell puts on Match Group. And even that, I'm going to do a little more research to make sure I want Match Group to show that they're owning the market more and more. But at the end of the day, these are the things that I use on a daily basis. We have retirement things. I have retirement calculator. I'm the number 2 user of retirement calculator in our community, even though I'm not retiring. I use real estate calculator every single day. We just bought a $22.5 million property, and we're in contract with a $7.5 million property. And I just ran a $4 million vacation home rental today on using our real estate calculator. We use these tools every single day to make better decisions. More importantly, to sleep better at night. Because I know that as long as these companies, I pay a reasonable price for them, as long as I pay a reasonable price for my real estate, the future will take care of itself. I just need to operate them well on the real estate front, and I just need to make sure these companies stay on the right path. And if that ever changes, I can make a decision from there. I can have the conversation in the community. Now, guys, we're making changes to the software. We're going to separate all of these out very soon. And the reason being is I made this software for me. Originally started, people asking us, how do I get that software? We made it for me, but then sold it to others. Now it's flipping. Now we're trying to make it better for our user. And that means not overwhelming them with all of this. But you can still get all this. If you go to the link below, everythingmoney.com/signup, you'll see that we're limiting the number of sales every single day. We want serious investors who are serious about changing the way in which they think and having the right tools to make those better decisions. So if you want to get in before all these changes happen, so you can get all the tools we've made in the past and get locked in on them, do me a favor, click the link, sign up now. It's $7 for 7 days to try it out. And afterwards, it's about $1 a day. You cannot go wrong. So go sign up now. Now, guys, final stock is Crocs. I know you might be laughing. My grandson has the most adorable green Crocs boots that he's absolutely obsessed with. He refuses to leave the house unless he wears these bright green Crocs boots. It's absolutely the most adorable thing in the world. Now, some benefits to Crocs, because guys, if you look at this chart right here, the all-time high is at 183. It's at 133, which isn't as bad as you'd think. And the 52-week high was 165. So in the last 52 weeks, it was within 10% of its all-time high from 2021, from almost 3 years ago. That's pretty impressive. But right now, a lot of insider buying by the chairman, massive buybacks, and the earnings improvements versus a cheap price on an absolute basis is what the Value Investor Club seems to think to be an interesting setup. So look at this, guys. This is actually an 8-pillar stock. Here are their share buybacks. Reasonable debt, mid-teens on the price of free cash flow and the PE ratio, high return on invested capital. I like the fact they're diversifying their products versus just the ugly Crocs shoes that Mo loves. The company has been very opportunistic in doing partnerships with other retailers, which included a $750 Balenciaga stiletto Croc. And the company also acquired Hey Dude, which closed in February of 2022, which has been massive for the company ever since. They paid $2.5 billion for $500 million in sales at the time. That's grown from $20 million 4 years prior. That company absolutely crushed it, and now Crocs owns it. In 2021, the company announced a $1 billion buyback, which is a lot considering their market cap is only $8 billion. And as of today, there remains $700 million left to plow back into shares. So where's this company going? EPS, according to analysts, $13 a share going to $18 a share. Kind of a big drop here. I don't know why that is, but it's there. And revenue growing 4%, 5% a year. Yeah, 2% here, 15, 7. But let's call it 4 or 5% a year. Not a ton. But remember, guys, the goal is to buy a future stream of cash flow for as cheap as possible. Whenever I think something I don't want, for whatever reason, I think to myself, would I buy this for $1? If the answer is no, then I know I have to move on because I don't understand it. If the answer is, well, of course I would. Okay, I want to determine the right price for it then. Because there are things I would not buy for $1. Like if somebody told me right now, to use Warren Buffett's analogy, buying all the Bitcoin in the world for $25, he said no. Of course I would buy it and immediately sell it. But if somebody said to me, Paul, buy all the Bitcoin in the world for $1 million, but you can't sell it for 20 years, I'd say no. Because then I look at it going, if I think Bitcoin's going to zero, why would I do that? With Crocs, this is probably a company that's going to generate profit for a long period of time, even if it declines. So let's go see what this company is worth to us before we go any further. So even though analysts have it growing, my personal bias is going to show up here in my assumptions. And that's the reason why you need to have your own, because you need to be able to come in here and do this yourself. If you understand the retail world more than I do, go do this. I did 0, 3, and 6% revenue growth. I did profit margins of 17, 20, and 23%. Same with free cash flow. For my PE, I did 13, 16, and 19, even though They had a growing ROIC. I still sat there and said, I think it's just something about Crocs itself. And I sit there and say, is it too much of a one brand thing? And I love the fact they own Hey Dude. And it's funny, whenever I go anywhere involving a lake, I look at people's men's shoes and there's all Hey Dudes in there. So it's a very popular shoe, growing like crazy. And of course, I did my 9% desired return. Hit the analyze button. The stock's currently at 133. I got a low price of 130. High price of 340, guys, a middle price of 212, which is giving a potential return of 16%. Do you guys see a pattern forming with Value Investors Club? Remember, guys, the Value Investors Club goal is to look at companies that might seem out of favor, but see fundamentals improving. Every investment is the present value of all your future cash flows. When you buy a stock, you're buying a piece of business. Even though they don't give you that cash flow, it's still going to be in the company's coffers for you to do. I have no idea where stock prices will go, but I do know that if I pay a reasonable price today for a company and it grows, my investment's likely to grow with it. And obviously, the more margin of safety I have, the better it'll do. So guys, the entire goal of an investor is to focus on buying any investment below their intrinsic value. That's why I do 9% returns, for that intrinsic value. The value comes from finding stocks that are priced significantly below what they're worth. As you guys saw from our Nvidia analysis, it takes some very optimistic assumptions to make a great buy right now. Why? Because the market's paying a lot for potential future cash flow. Unknowingly, probably. But remember, just like market sentiment on the high side makes things hard to buy, on the low side, it'll create immense opportunities. Look at China right now. There's probably a lot of potential in China because the fear is so prevalent and so widespread. You have investment houses saying, I'm not even going to touch China. But remember, in my opinion, the fear in China has existed for a long time, and China's getting better. I was just on a trip this last week, and everybody's saying, oh no, China's never going to recover. I'm like, wow, never going to recover? Sounds good. But that's why I'm investing in Alibaba. Again, don't buy it. But as you saw, Value Investor Club likes it as well. Now, guys, there are lots of lessons in history. And people tease me for talking about Microsoft all the time. It's because it's the first time I realized the disconnect between people who are supposedly knowledgeable and the markets. A tech CEO telling me in 2012 that Microsoft was dead because it was selling for 9 times earnings, even though their revenue and profit went up every single year. Now, a harder example is Apple, because Apple in the early 2000s was almost dead. Microsoft was not. It was growing every single year. And remember also that even when Microsoft was $52 a share, at the market peak in 2000 and got as low as 11 or 12 in 2010 or 11, Steve Ballmer still was able to triple the revenue at Microsoft. Remember, the retail investor, the people out there are going to overreact on the high side and low side to the market and what's going on there. This top stock to buy today is where there's the biggest disconnect between value and price, and that happens because of market perception. My goal, my personal strategy, is I'm trying to find a portfolio of diversified stocks that fit this criteria. And these include, there are 18 companies in there that currently have Alibaba, Sprouts Farmers Market, even though that's probably overpriced right now, Target, American Express, probably overpriced right now. But for me, I'm more important for not over-concentrating in a single stock. But really, that's the real way to get major returns. Remember, you want more investment ideas? Join this community. Go click on that link. You're going to get a lot more insight and a lot more ideas. I go in there and scan there for ideas. You're not going to be right on every stock, but if you have a diversified portfolio of undervalued stocks that you buy with the same criteria, you're going to likely do very well over time as long as you can stomach the ups and downs. When I ran backtests 25, 27 years of just systematically buying value plays based on a few criteria, they always outperformed the market over 25 years. Now, in any given year, probably not. In any given year, it was a toss-up. But the point is, on the good years, they massively outperformed. So guys, the thing I want you to remember about this whole process is it's focusing on value, not just price. You want the price to be lower than the value. Guys, you're a smart person. You don't go to the store and they ask for $80 for a sweater and you say, can I pay you $100 for it? That's the difference. I'm just trying to get you to realize that Mr. Market's out there telling you, hey, the price of the sweater is $100 today. And you say, but it's not worth $100. I'm not going to buy it. Same thing. That's what I want you to do in the stock market. You can sit there and just be patient, wait for the right pitch and swing. Guys, I want you to make sure you do the right research. Research is annoying. I hate it. That's why I have a community here. It allows me to do research using the masses and not just me. You have to be able to sit there and see which research matters the most to you. So guys, if you want to see the 18 stocks in my current portfolio, watch our next video. Thank you for your time.